Hello everybody and welcome to our discussion of capital budgeting. This particular lecture, this video is just an overview of capital budgeting and the various methodologies. We're going to have separate discussions in later videos regarding each individual type of capital budgeting methodology. And again, this is just an introduction to it, but we'll have more examples later on in later videos. So first of all, before we get too far into it, we need to define what capital budgeting is. And whenever we talk about the word capital, we're talking long-term assets, specifically long-term operational assets that we use in our operations. So this budgeting itself, we're trying to budget for it. We're setting aside money, determining how we're going to finance it, what expected return do we plan. And a lot of times it's simply comparing multiple alternatives, multiple projects we may want to enter into. The reason we're doing that is this number 2 down here, we have limited resources. There may be a lot of projects out there that are profitable, but we don't have enough money to invest in every single one. So we have to take a look at what cash we have, take a look at the alternatives for our projects or our investments, and determine which one's going to give us the highest return on that investment. Now the challenge with capital budgeting is, again, this is long term. We don't know exactly how things are going to work out for the next 10 or 15 years. We tend to have somewhat limited information, but it's the best information we have at this time. That's the key thing with that. So we're planning for the long term with the limited information we have. Now we've had several different discussions on operating budgets in general, the master budget overall and all the operating budgets within it. And we talked about financing budgets as well in that master budget schedule. Capital budgeting is really an offshoot of that, because now we know what funding we have. We may know that we plan to expand in the next year with our sales. So that may lead us to believe we need to expand and purchase more capital. The operating budgets are allowing us to run the business on a day-to-day basis. Capital budgets, we're incorporating our long-term strategies, because once you buy a long-term asset, you tend to be somewhat locked into it for a little period of time. So we have a few steps that we're going to go through. Now, this is not something you need to necessarily memorize. Different texts discuss this in different ways. But you're going to have to develop these longer-term strategies or goals to guide your company into the future. What direction do you even want to head into? Some companies, for example, they start up with one main product line or service line, and then they diversify a little bit. But when you're looking at these alternatives that we're going to talk about in the next step, you need to really know, are you willing and interested to diversify, or do you want to stick to your core operations? Because if you don't plan to diversify, that'll eliminate a lot of alternatives that are out there. Number 2 is really planning in general and reviewing those alternatives. So you're gathering information about what alternatives do you have for investments. What are even out there? You also have to grab as much data as you can on the cash inflows and the cash outflows that you expect throughout that asset's life. And now you have all your alternatives. You're going to have to rank them based on the risk, the potential returns, the length of time, and choose which one or multiple ones you want to invest in based on limited resources. So you only have such a pool of cash. Maybe you can invest in 2 of those smaller projects. Maybe you can only invest in one of the larger ones. The next step is, now that you've made a decision, execute that decision, execute that plan, which is sometimes referred to as just directing. So you have your data, you've made a decision, now act on it quickly. Don't wait too long for that, because things may change. So implement the plan, purchase whatever assets are necessary, obtain whatever financing is necessary, and you're good to go. You're operating into the future. The last step is, after you've already implemented the plan, you need to control. You need to track the actual results, compare them with the budgeted expectations, and if things aren't going according to plan, find out why. Maybe it's better, and if that's the case, we still want to gather that data to see, why did we fall short in our budgeting when the actual results were so much better than expected. We want to know that. But if things aren't going according to plan, we need to know why. Was it a mistake in budgeting, or have some of the assumptions just not held true, or somebody not doing a good job with whatever they're supposed to be managing? Now, as far as measurement techniques, this is part of that planning process. You need to predict what cash flows you think you're going to have. That's the whole reviewing alternatives and quantifying the potential returns. All of that was kind of built in together. So we're going to talk about 4 major methods for how we measure the expected inflows and outflows of cash, and what does that really mean to us as far as profitability. These 4, again, are going to have their own discussion, own lecture to go into the great details of it with examples, but this particular overview is just introducing them. So we have what's called the payback period, and we'll see a few slides on each of these in just a little bit. The payback period, the accounting rate of return, sometimes referred to as ARR, net present value or NPV, and the internal rate of return or IRR. One thing I want to mention here is that you don't necessarily just have to pick one and stick with it. You can do this analysis on 2 or 3 or really possibly all 4 methods, but the problem with that is that sometimes the results from one will make you choose, let's say, project 1. The results from another will make you choose project 2. So then you're left with the question of, which technique do I weight higher? So now let's go into a little bit more detail. We're still in the introduction video, but we're going to go into a little bit more detail on the methods, and then we'll see the great detail in a later lecture. So first of all, payback period. The calculation for this one is straightforward. It's your initial investment, whatever money you had to pay in to buy this asset or invest in this project, divided by the cash flows expected per year, cash inflows. I should say net cash inflows there. Now this is a really easy calculation when the amount is equal every single year, because then it could be something as simple as you paid $100,000 for something up front, and you get $25,000 of cash inflow, maybe savings or more revenues, whatever, $25,000 a year for the foreseeable future. That means that in 4 years, you've paid this back. So it's a very simple question when it's equal cash flows per year. It's not quite as simple when the cash flows come in at odd numbers each year. So the first year is $25,000, the second year is $18,000, then it's $32,000, then $5,000. It gets a little odd. You really have to track the cash flows and try to figure out, okay, in what year did we finally cover equal to or more than $100,000? And then you want to try to figure out, well, what portion of that year did we actually hit the $100,000? So again, we'll see more detail in the payback period video, but I just wanted to give the explanation of what you're going to need to do when you see that. It's by far the simplest of all methods, and one thing about it is that it ignores the time value of money. In other words, it assumes that if we receive a cash flow this year, it's the same value as if we received the same dollar amount of cash flow in 10 years. In reality, we know that's not the case. We'd much rather have, let's just say it was $10,000 we're talking about. We'd rather have the $10,000 right now, so then we can go out and invest it, as opposed to having to wait 10 years to get the same $10,000. The values are just not the same. Time value of money is just another way of saying interest, and we're carving interest out in those cases. So the payback period, when we do that calculation that we just talked about, it basically tells you how long it'll take you to recover your initial investment, not hitting any profit at all. We use this method when there's a lot of risk with this project, and when the company's just really concerned about the risk. They want to know how quickly can we at least cover ourselves so that we know, hey, the risk is gone, and then anything past that might be profit. The shortest period is the best because it has the least risk, but again, the main problem with it is that if you're just comparing two projects just using the payback period, then you're going to pick the shortest period, even though you may very well have huge returns after the payback that are ignored. So an example here is that we have an investment that takes 10 years to pay back. Remember my $100,000 example. Or no, in this case it's a $10,000 project. It's $1,000 per year that takes 10 years to pay back. So we say, hey, it's 10 years to pay back, we're good to go. But let's assume in the 11th year it has a $1 million per year return. We're ignoring that $1 million amount because we've just been concerned about getting our initial $10,000 back. So now that's an extreme example, but I have seen textbook problems that go into that example. So if let's say we had this investment that takes 10 years to pay back, and there was another investment that had a payback period of 9. And then after that 9th year, there's not much coming in. You get maybe a few hundred per year. We would pick the 9-year payback project because it was the shorter period and therefore the less risk to it. But the problem is, if this longer payback project, in the 11th year, it would have had a $1 million per year return that we just flat out ignored. So payback has certainly its flaws or drawbacks. We'll move on to the accounting rate of return, the ARR method. Now this is very similar to what you may have covered in the financial analysis topic way back in financial accounting. The basic return on investment, or ROI, which is sometimes also referred to as return on assets, because it's really the assets that you're investing to begin with. It's the same basic idea for this calculation. The big difference is here we're using the accrual-based operating income, and we're using an average across the entire project. We want to know overall what is our percentage rate of return rather than any specific year. So we're looking at the average annual operating income divided by the average amount invested. Now the thing with the average here, the average amount invested, with some projects you have to buy an asset and that's it. So in that case you would have invested $10,000, $100,000, whatever, to buy that asset, and that's your only investment. In other cases you're going to have to buy the project or buy the asset and then maybe use up some money, invest some more money over the life of that asset. Could be for expansions or maintenance or things like that. But you just need to know, what did you have to invest to keep this project running? And then did you have to have any working capital that was tied up for use in this project? And now you get it back at the end of the project? We'll see more of those details in the separate video. But again, it's all about that question of how much did you have to have invested on average throughout the entire life of the project. This one, like the payback period, does not consider the time value of money, so it doesn't really matter when the cash flows happened, as long as it was within this life of this project. Now we get into two of the methods that do use the time value of money, and they're more commonly used because of that. They're more commonly used for longer projects because of the fact that it considers time value of money. This first one is called net present value, or NPV. And here we're taking the present value of the net cash inflows. So again, that could be multiple streams of cash flows. Maybe we get a certain amount every year. Maybe it's the same amount every year, which would be an annuity. And that's very easy to calculate. Maybe we get one lump sum at the end of this by selling the asset or by pulling back our working capital that we had to invest. That could be a situation there. But in any case, we take the present value of the net cash inflows, which again, all of this we're going to talk about much more in the specific video for net present value. We subtract out the present value of the net cash outflows. Again, this is all the money we had to invest, whether up front when we bought the asset or possibly down the road. And we're subtracting those two present values to get a net present value. As I mentioned, this method uses the time value of money, so it considers when that cash flow changed hands, and it more heavily weighs cash that changes hands early on. But before you can use that, you must have a given discount rate in your problem or in real life scenario. They have to tell you what the interest rate you're using is. What discount rate are you considering? Because then when you go to the time value of money tables or your financial calculator or the website or whatever, you know what to use. Now the complexity with this is that it's not always that easy to determine the present value of the different cash flows, because there may be annuities, which that's relatively simple. You may have some lump sums, but it may be a different amount per year, and you'll have to do several individual calculations. That's where it can get complicated. So once you're done with the net present value, you're going to get a dollar amount. Now what this tells you is your amount that was above the expected rate. So if you had a discount rate of 8% you were using, if you ended up with a 0 NPV, that would basically tell you, yes, your project was profitable right to the discount rate you expected. So you're making just as much return as you expected to make, but no more. So 0, it's acceptable. You don't need to decline the project, but it really doesn't help you much to accept it. So yes or no, it doesn't really matter. But if it's above 0, then that tells you you're making a little bit more profit than what you required. So that's a good thing. It doesn't tell you the exact percentage rate of return. It just tells you it's above your desired rate of return. And you just look at the dollar amount, and if it's a large dollar amount, it's better. If it's a smaller dollar amount, it's not as great. Positive net present values are acceptable, but negative, you don't want to accept that because that's telling you you're not quite making your desired amount. So that's not a good thing unless you're willing to change your discount rate. The drawback with net present value, since it's a dollar amount, is you can't really compare projects that are of different sizes, because if they require a different investment up front, you would imagine that, if you're going to have to pay a lot more for a project, you really want it to be more profitable. But the dollar amount just doesn't tell you that. You can't compare projects of different sizes. The other drawback I mentioned is that you never really know the true percentage rate of return. You just know whether it's above or below your desired discount rate. So we're on to the last method, the internal rate of return method. And here we're saying, this also considers the time value of money, just like the net present value method does. The big difference is that when you use the IRR, internal rate of return, it tells you what the final rate is. Remember, NPV gave you a dollar amount. IRR gives you a percentage rate. Now, the way you analyze this is you determine, or you compare this to your desired rate, what's sometimes referred to as the hurdle rate. Let's say your company says you must have an 8% return before you invest in a project. If this IRR, your estimated IRR, is 12%, then you're good to go. You're well above your discount rate, your hurdle rate. The problem is it doesn't really tell you exactly how profitable it is. It just tells you the rate of return on your investment, which isn't a bad thing. You can compare different size projects a lot more easily with this. Now, what this essentially is doing is it's discovering what discount rate would be required to get NPV to 0. In other words, at exactly what discount rate do your cash inflows equal your cash outflows when considering that time value of money. A big drawback with this method is that if you're using traditional textbook present value tables, depending on, if it's the textbook problem, maybe they'll give you one that works out perfectly. It exactly falls in one of those rates in the table. But if it's a real life problem, those present value tables may be difficult for you to get a precise internal rate of return. You can tell that it's somewhere between one column and another column. So let's say your tables gave you 1% for each column. You may be able to tell that it's between 9 and 10%. Those columns, that gives you the right factor for your problem to work out. But it may be more difficult to figure out exactly where it is. you may have to do a little bit of trial and error and try out different factors, kind of the hot and cold or the warm and cold game where you're too hot, you're too cold, you're above, you're below where you need to be. So that's what kind of happens there. You interpolate is what the term is. You interpolate to get closer to your actual number. So it may take more time doing this with present value tables, but if you have a financial calculator or even Excel or even websites that do this, you can get it accurate. You can get it very accurate. And that's basically what I'm saying in this slide. So finally, to a conclusion, again, this was just an introduction to this discussion. So I said early on that we were not locked into one particular method. We can use combinations of these methods to make the best decision, but you have to know which one would you almost have to rank your methods. Because if they tell you different projects are better under the different methods, okay, which method now do you listen to? Now, if they all tell you Project 2 is the best method, go with Project 2. But because of the way the methods are set up, that's not always going to happen. And my last reminder is that each of these 4 methods is going to be covered explicitly and separately in their own videos. So we'll have examples, we'll have more detail on it. But this should be a good introduction to that discussion. So hopefully this has helped to start the ball rolling on this topic. I thank you for your time, and I will talk to you in our later discussions.